Welcome to a beautiful, beautiful sunny Friday, January 19th day. Thank you for everyone for joining. My name is Michael Wardy here at Source Advisors. I'm a Senior Strategic Director, and I want to take this opportunity to wish everybody a Happy New Year. I know we're 19 days in, as I mentioned, but we are going to start out the new year with some exciting information and content and useful information and content. Today's live broadcast is streaming on LinkedIn, YouTube, and X. And with that, I'm excited to introduce two of my fellow colleagues, Ben and Kelsey, who have been with us for a bit of time now and have a niche in an area in a deep knowledge in an area that I thought would be worthwhile to do a live interview with to help people understand some of the nuances in what this title of our presentation or our discussion is about salt. So before I keep rambling on, a couple of housekeeping items. If you do have questions, go ahead and send those in the chat room. If you're on LinkedIn or Twitter, or not Twitter, X, sorry, or YouTube, go ahead and put them in there. If I don't get to your questions, I apologize. We will respond to them afterwards. I know a lot of people are going to have a lot of questions about salt and what's going on. To get started with, Ben and Kelsey, welcome.
Thanks, Michael.
Thank you.
Absolutely.
Thanks for having me.
Just to get started with, can each of you take a couple seconds and introduce yourselves? Give a little bit of a background and some insight of where you've fallen into this world of salt. And if you want to use any puns, please feel free.
Absolutely. You know, sales tax and salt's everyone's favorite topic. So somehow I've made a whole career out of it. But I started in corporate income tax at a private family-owned firm, and then joined at Avalara, actually, which is a tax technology company, and was there for the better part of the last decade or so, but really excited to be with Source Advisors and focus on our salt channel. And thanks for having us. This is exciting. My first time doing LinkedIn Live, so it's fun.
Thanks a lot. I'm Ben, and I fell into the world of salt purely because of how intricate and exciting it is, and of course because of the puns, because what's the point of working in an area that you don't get to throw in a bit of salt in everything that you talk about? State and local taxes is a really interesting topic. It's industry agnostic. It is relevant to a large number of companies, whether they be multi-state or they be even operating just in one state, but they're purchasing things or employing people from around the country. We'll get into all the nitty-gritty a bit later. My background is I've been working in tax consulting now also for the better part of the last 10 years. Always been involved in credits, incentives, whether it be on the research and development side, whether it be on the commercial or residential real estate side, but always been operating in the tax incentives and strategic tax work. As you can tell from my accent, I'm not originally from the States. I am originally from Australia, where I was working on the research and development tax incentive out there, and moved over to America about a little over 2 years ago with my wife, and we've been really enjoying it so far. So, Michael, thanks for hosting today, and looking forward to sitting alongside Kelsey and diving into the salt topic.
Beautiful. I love it. And that's one thing I just want to take a sidestep on something. Source Advisor. So we've been around for 40 years, and we've always been focused on working with CPAs and their clients in identifying ways to properly increase cash flow through the different incentives that are available. We brought the salt practice in just about a year ago. And the reason for that is because we were having CPA firms come to us and asking, do you have expertise in this? Do you know anyone who can help out with this? This is a big need, and this is a big area and a challenge for a lot of people. We'll get into some of these challenges in a little bit, but we brought it in-house because we want to make sure that we provided the right consulting services to our CPA firms that we work with and ultimately their clients. Before we get into details, all three of us have dogs. I know this is going to sound kind of like a weird question, but I'm going to ask, what breeds do each of you have? What breed dogs? And Do they even think about salt? I'm sure they do.
I mean, they are obsessed with bacon. So the high sodium meat of all meats. But I have Mr. Burt Reynolds, a little mini golden doodle, and then Barb Lucy, who is an Aussie doodle. She's very high energy. But it's funny because one of the reasons why I fell in love with sales tax was an original client that we had in Seattle, and he went under audit for buying his dog food from Oregon for use tax, and he wasn't divulging that he wasn't paying the sales tax. And unfortunately, it was like a country song, right? Where, they lost the pet resort and the house and all of the things. And it was horrible. And that's where I was like, you know what,
Kelsey,
I want to continue to do this. I want to help.
Kelsey, if you want to sing, I'll bring out the guitar and we can do that for the country song.
No, there's other people on our team that, are much more well versed in the musical world.
Sure.
I'll go to concerts. I won't play. Ben, how about you?
Yeah, so I've got two dogs. They're both the same breed, Cavalier King Charles Spaniels. They're really adorable. One came with us from Australia. The other one we got in New York State. And absolutely, they know all about state and local taxes and salt. In fact, one of their names is Dash. And at a previous role, I came up with a little marketing campaign around Dash of Salt. So there was always plenty of salt references out there with them. And the second one's name is Lady, and we just know how salty she gets when we give Dash all the attention. So those two definitely have lots of background and reference to it, and I do consult them before any major multi-state tax question comes forward. I veto everything through them.
I love it. We have a dog as well. We have a Havanese, and his name is Stash, and he's 10 and a half years old.
Wow.
Still learning about salt and very curious. So let's get right into it. I know that we have some questions that came in even before the broadcast. We had a couple of people that said, hey, I can't join, but can you just give me some additional insights? So some of the questions are going to come from there. Just to start out with, we hear about Nexus studies. We hear about Nexus. What is Nexus?
Yeah, well, there is a shampoo called Nexus with 2 X's, but it's not that. The way that we use Nexus in the salt world is essentially it's your obligation to file and remit sales tax to the state. It's the connection that ties you to the state. So whether that be through physical presence or the new concept of economic nexus, it's really whether or not you have to get registered. And sometimes that can be through filing income taxes there as well. But
yeah, what I would even say on that, Kelsey, is that it's not limited. Nexus isn't limited to sales tax in any way. It's really Nexus is sufficient connection, and it can be across any state tax. And it's incredible how many activities trigger Nexus and how businesses are not even aware that they have the requirement or the sufficient connection with the state to file a certain state tax. So it is very, very wide-reaching.
Is this across all industries? Are there industries that are more challenged, I guess, with or struggle with salt versus others?
Yeah, I would say the list is, somewhat extensive, but just to give you a short list, software companies really, really struggle. Oftentimes they hire remote employees across the U.S. It's difficult because the laws are very nuanced based off of their products. Any type of business that's doing omni-channel commerce, like marketplace sales, e-commerce with high revenue or transactions. And then manufacturers are a big one that oftentimes believe they don't have to pay, but realistically, there's been a lot of changes that do make them obligated to at least register and remit. So
it is, but I mean, overall, what I would say is it is industry agnostic. There are these industries that have a lot of complexities associated with their taxability. So like whether or not what they're selling is taxable in that particular state. But really any industry that's selling either products or services in multiple states, like there's a high chance that there are complexities that relate to what it is that you're doing. So what I would say is the examples that Kelsey gave are excellent in terms of if you're in those industries, like definitely keep an eye out and definitely take, I would even say, proactive measures to ensure that you're filing everything correctly. But really any business that is selling, whether it be a service or whether it be a product, even if you aren't under the impression that that product or service is considered taxable, you would still want to make sure that you look at the requirements. And that's the whole concept of nexus. Do you have nexus with the state? And there are so many different ways in which that can occur.
So I feel
one
like
that comes to mind is like medical devices. Yeah, like the medical device industry, they send reps out across the US, right, to demonstrate their products, make sure that they're trained on how to use them. And, you know, those kind of like traveling reps, right, create that footprint across the US. So definitely it can be really, it's very nuanced by industry, but, you know, definitely let us know if you have questions or think that you might have triggered it.
So wait. So if I'm a medical device salesperson and I live in Illinois and I travel to Montana, we have to pay sales tax in Montana?
So I think there's an important nuance there to mention as well, which is, Michael, you're talking about paying sales tax. There's a concept of collecting sales tax, which is what nexus comes in. So paying sales tax is me as a customer going to a vendor and actually paying it. But the whole concept of nexus is much more about collecting sales tax from customers. So if you have a salesperson who goes to Montana, depending on what they're doing, depending on how long they're staying there, depending on a wide range of circumstances, what might end up happening is they end up triggering nexus, which means the sale that you make in that state needs to have sales tax collected on it. And even if it doesn't need to have sales tax collected on it, you may be required to register in that state because you have nexus. Kelsey, does that track?
Yeah, it depends on the state. There's like 5 states that don't have sales tax, but beyond that, if you're traveling there, you're making sales, most likely, yes. You have to collect. So,
Okay. And I feel like this all started, and I know we've done CPE sessions for a number of CPA firms throughout the country since we jumped into the salt business and the industry, consulting on it. This all started with the Wayfair case. This is where kind of all South Dakota versus Wayfair and collection, because before that, and I sort of remember when I would order something online, I don't think we were being charged sales tax. Maybe we were. I don't really remember. Maybe I do. But were we being charged sales tax? Were we not? I know online now, when you order something on Amazon, we are. But was that the big turning point?
Right. Yes. I mean, I live here in Seattle, right? And so before Wayfair, Amazon actually particularly moved to Seattle to try to take advantage of that loophole and get away with not having to charge sales tax on their online sales. But Wayfair got challenged by the state of South Dakota. It got pushed all the way up to the Supreme Court. And like they tend to do, they left it up to the states and made it incredibly complex. It was like a domino effect where all of these states decided to set their own threshold for remote sellers. So when you have physical presence, there's oftentimes a $0 threshold. If you make a sale in a state, you have to collect and remit, right? But for remote sellers, if you don't have physical presence now, oftentimes those thresholds start at $100,000 in revenue or 200 transactions when you have to start collecting. So it's made it incredibly complex for businesses to stay on top of. And all of those rules and regulations vary by state. There's a few other states that have higher thresholds like California, New York, and Texas. But beyond that, the 100,000 or 200 is a good rule of thumb to kind of keep your eye on, right?
Yeah. So, all right, one question on this, because I actually got a question on this. It was earlier this week. The 200 transactions. Is that if I buy something, if I buy, I don't know, a loaf of bread, and then I go back and I buy 2 more, is that 3 or is that 2?
Probably invoices, right? Keep me honest here. This is, but one good thing is that some of the states are moving towards like a more simplified method, right? So we have seen changes on that threshold. So some states are starting to lift the 200 transaction threshold, make it a little bit easier. But yeah, it's hard to stay on top of those changes, and so you certainly want, guidance or counsel to know what the states are doing.
Yeah. So, and Michael, what I might add a couple of things here. So first and foremost, a reminder that it's not about the people buying the bread; it's about who's selling the bread, right? So if I sell, and a transaction would be each transaction. So if you end up buying it's sort of each time somebody pays for something, that's a transaction. So it's not so much units as much as it is transactions, because obviously there are so many different ways. If there's so many different ways to describe it. I could have a 200-piece Lego set. Does that mean that there's 200 units and therefore I've triggered Nexus? Obviously not. But if you've got 200 Lego boxes, then yes, that probably would be the case. So I would say it's mainly about the transactions. If someone bought one transaction, 200 Lego boxes, it would probably count as one transaction. So what I would probably say here is important note regarding the Wayfair ruling, the Wayfair versus South Dakota, is the big change that happened was all about this concept of economic nexus. So historically, in order to be required to register and collect and remit sales tax, you had to have a physical presence. And that is still the overarching policy. You have a physical presence. If you're physically in the state, if you've got a shop in the state, you've got employees in the state, you've got inventory in the state, anything that you're physically touching a state, you're required to collect and remit sales tax. What changed is out-of-state sellers. So now if I'm a company based in another jurisdiction, which is where I have my office, and I sell into another state, this is where it started to get interesting. Wayfair is a furniture company that was trying to take advantage of the fact that it didn't have to go ahead and collect and remit sales tax in the state of South Dakota because it wasn't physically there. And this whole case the 2018 case was the end of a long line of smaller cases which were challenging this concept of nexus. Interestingly enough, economic nexus actually existed with income tax well before the South Dakota versus Wayfair ruling. So it's not a foreign concept, but the whole idea is that states want to derive revenue. States derive revenue through things like sales tax and income tax. So states don't want people to take advantage of the fact that they can sell into their state without being able to tax that. So that's the whole concept, and that's where economic nexus for sales tax is born. So if you would have been paying sales tax on e-commerce, you might have been, but typically speaking, if the company didn't have a physical presence in that state, you wouldn't have been charged sales tax because they were able to skip it.
And
all right. Go ahead, Kelsey, and then I'll.
Yeah, I was going to say there was other acts on the table even before the Wayfair challenge, right? There was the Marketplace Fairness Act, which kind of went almost directly after Amazon, but that one ended up getting tabled. And so this was really a long time in the works, and I just decided to ride out my career in sales tax the whole time and take the gamble and see if it would ever change. And it did. It ended up becoming so complex that businesses just have had to look at outsourcing, sales tax or automating it in order to stay on top of it, because you need a trusted advisor to help guide you through this, or a whole team to manage it once you grow beyond a certain point. So.
And that's what I was going to add is it's not getting easier. So I know with what we're building out here at Source Advisors and the recent acquisition of the Salt practice, how are we assisting clients?
Yeah. So we do consulting and compliance services. But really how I like to think of it is the two go hand in hand, right? Oftentimes, in order to have a great compliance process in place, you really need to make sure that you get the consulting done to look at any historical liabilities. So we can offer risk assessments on the consulting side. Other services that might come up from, historic liabilities, we can offer audit assistance. If perhaps, you've overpaid or, not collected, we can do tax recovery work for you. But then on a looking forward basis, we can take over the returns. We can make sure that you have the correct taxability matrices in place, and we can help get you registered or do things like voluntary disclosure agreements to help address any historical liability.
Beautiful. I think that's
kind of breadth
key.
of your service.
Yeah. And that's key for all businesses, is that doing it right the first time will save so much money and angst and stress and wasted resources by saying, oh, I'll fix it later. Get it done right the first time. I want to do a quick transition, though. I want to talk about, Ben, you and I were together last week, and you were discussing about voluntary disclosure agreements. I'm new to this world of SALT. Thankfully, you and Kelsey are not. Can you help, not just me, but our audience understand what exactly is a voluntary disclosure agreement and what are the benefits?
Sure thing. I think it's a really important topic to be aware of and to understand how it operates. What I will say is, so Michael, you said something really interesting. You said that it's really important to get it right to begin with. So try and proactively take measures to, when you're starting your operations, when you're starting your business, or when you're expanding into new states, to take proactive measures here. The thing is, as nice as that is to talk about, because of Wayfair and because of the way this country works, that there are essentially 50 different countries in the one country, the chances are you haven't actually been able to get it right at first. And the years have gone by and you have developed a footprint that you haven't even realized that you developed. And this is where this whole concept of what Kelsey was talking about before, nexus studies, like a comprehensive analysis of, well, let's just look back for a second and see what kind of damage you've done. I mean, we get so excited growing our businesses, but at the end of the day, what we see is whether you're in real estate, whether you're in distribution, whether you're in manufacturing, it doesn't matter. We've developed a footprint. Let's retrace that footprint to see where your liabilities are, to see where your requirements are. That is the nexus analysis. We then move into this concept of, how do you fix it? So thank you, Source Advisors. You've now shown me all of the problems that I have. Are you only show me problems? No, we want to give you an analysis of what it is that you've done and what it is that your footprint looks like. You probably haven't been audited by any state bodies yet. You probably haven't been asked the questions. And if you have, you would know about it. So now the question is, you've now shown me that in this particular state, for the last X number of years, I actually should have been registered for sales tax, registered for income tax, filing. I should have done that, but I didn't. What are my options? And that's where the topic of voluntary disclosure agreements come in. Voluntary disclosure agreements are a common concept in the tax world, where you can come forward with your tail between your legs, so to speak, and say, look, we kind of messed up here. We didn't know. We would like to come clean with the state. Now, there are really major benefits of going through that process. First and foremost, going through that process essentially means that the state has mercy on you. If they come and audit you, or the gloves come off and all bets are off, they're coming after you, and it's a great way for them to generate additional revenue through penalties, through interest, and really, really make life difficult for you. The onus is on the taxpayer to make sure that they're doing it right. A voluntary disclosure agreement is saying, please be nice to me. I have made a mistake. I'm coming forward so I can reduce my liability. Now, let's say a business has been operating for 10 years and you run an analysis and you realize, oh my goodness, for the last 9 years, there are like 7 states that I should have been collecting and remitting sales tax on all of my sales, and I didn't. The state is now saying, so for the last 7 years, you owed us X dollars of sales tax. The state wants that. For the last X number of years, you were supposed to register. You didn't. There's something wrong with that. You were supposed to do that. So what happens is, at the end, you're coming clean and you're saying, so what kind of deal can we strike? And each state has its own process for a voluntary disclosure agreement, but they typically, across all states, limit the look-back period. So you can have fewer years that you have to repay your sales tax or your income tax on as a result of you voluntarily coming towards them. Some of the states have 2 years, 3 years, 4 years. And I believe the largest look back period is 6. So I'm not 100% sure, but I think the largest is 6. But essentially, it goes and says, that's where we're going to draw a line in the sand. Before that, it's all done. Don't worry about it. Let bygones be bygones. Let's just get you up to date for the last predefined look back period. Also, we're not going to charge you any penalties. In most cases, the state will say penalties for not filing, for all those issues that will accumulate over time. You don't have to pay those penalties or waive those penalties. All of a sudden, a business now, they've gone through a nexus study. They've seen, okay, I have exposure in this particular state. I've had it for X number of years. This would be my liability. Do I go and address it and pay back up to a certain number of years based on that state through a voluntary disclosure agreement, or do I risk it? Do I register now and hope that they never really catch me? That's going to come down to a business decision for each business and depending on the liability.
Sure.
The voluntary disclosure agreement piece is
and that's where we can help.
Well, that's 100% right. So
Yeah,
when we talk about getting money back into businesses' pockets, if you think about it conceptually, a voluntary disclosure agreement is saying you haven't been audited. So you may spend the rest of your days never being audited and you never have to worry about it. You got off, so to speak. Although no one really gets off. You know, the only two certain things of the world are death and taxes, right? Ultimately, you're going to have to come and pay the state one way or another. So, but the question is, now you've identified it. If you wait, the interest, the penalties, the taxes owed will grow and compound. We can actually show you what the difference would be if you pay now versus you leave it and the potential exposure that you would be required to pay if you got audited next month or in a year or in 5 years. So that's our value-added source advisors, is being able to help you mitigate the exposure and effectively save you huge amounts of fees in terms of penalties, taxes owed, and interest by getting in front of the particular state voluntarily. Voluntary disclosure agreement.
And sometimes
yeah, go ahead, Kelsey.
Sometimes those penalties can range like very, very high. They can be anywhere from 25 to 39% by state, and so you can really see that cost breakdown on what we can save versus not, and what risk you'd be taking. So
I think honestly, if you're trying to grow a business, you definitely don't want to be in a situation where something can catch you by surprise. You don't want to be
or go through merger and acquisition. Right.
Yeah.
Make sure your due diligence is in place.
You don't want to be in a situation where it can catch you by surprise. You don't want to be in a situation where you're not in the know of what the ins and outs of your business are. So what we're proposing here is state and local taxes is complicated. It's difficult. Each business, and again, across all industries. So first you need to get in the know. You need to identify. You need to demystify. You need to have all your questions answered so you're no longer in a position of unknown. Now that you've got that, you will be in a strong position to decide, how do I want to deal with this? One of the ways you might decide to deal with it is ignore it. That's your entitlement as a business, and you'll have to wear the consequences if the state comes after you. Some ways are, let's voluntarily disclose that we made a mistake and let's get on top of it. Either way, it puts you in a position that you know what your business is liable for and what the footprint looks like.
So you brought up a good point as far as for mergers, acquisitions, sales. There's a lot of activity going on, has been over the past couple of years, will continue probably for the foreseeable future. I would think that a company that's buying another company, this would be a fairly important piece of information to have. Do they know, like when they're going through the due diligence, do they know that this has been flagged and they are compliant, or is it just we never knew about it, we didn't think about it from the acquirer's perspective?
So I think there's a few points to mention here.
Yeah, oftentimes.
No, go, Kelsey. I'm happy for you to take it.
Go ahead, Kelsey.
Either way, yeah. I mean, essentially, oftentimes they do go through the due diligence process, right? Investors will want to see that. And, depending on how they structure the sale, they could perhaps, inherit that liability or, pass it on. But Ben, go ahead. I'll let you talk to it.
No, that's okay. So Kelsey's 100% correct. There are instances where the liability will follow you. So let's take a step back. Sometimes the due diligence process will cover state and local tax liabilities, in which case a deal could die. They could say, wow, you have huge liabilities, huge exposure. We're not going to buy your company. We're not going to merge with your company. You can then turn around and say, well, what about if we fix all that up through the likes of a nexus study, a voluntary disclosure agreement in the relevant states? It's fixable. So during that process, I guess if you're planning on going to market to buy a company, to sell your company, this is what you want to get in front of. You want to say, I don't want them to open up the closet and see a bunch of skeletons. I want to make sure we're buttoned up completely. So that's the first piece. The second piece is sometimes you don't do that. And then sometimes the acquisition will go through. But oftentimes, depending on the terms of the agreement of the acquisition or the merger, sometimes the liability will actually follow the original owner. So it's almost like just because you're selling doesn't mean you're scot-free. Sometimes you might be looking to exit your business. You've been running your business for 20 years and now you want to sell it to a conglomerate and you want to move on. The reality is you've sold your business, but you're not off the hook for the liabilities that you've generated sometimes. So I think it's important to keep in mind that when it comes to acquisitions of business, whether you're buying or selling, state and local taxes need to be front of mind because they are complex, they are risky, but they are also an easy fix if you are all above board about it. So it can be the cause of a massive headache, but you can reverse it if you go through this process of nexus analysis and voluntary disclosure.
So just so I understand, I sell my business. 2 years later, I'm relaxing, beachfront property, loving life. I could still be liable?
Very much so.
That ruins my retirement, by the way.
Well, it does. And it's funny because a little while ago, I had some conversations with some companies who are about to go through that process. Like we're ready to retire. And so it was interesting because we had some options for them. We were able to provide them with incentives for their business, so additional money back in their pockets, or state and local tax consulting to make sure they were buttoned up. They said, table the incentives. We want to know exactly what we need to do so we can actually move on with our lives. So we were able to get in with them. We're able to help them with that analysis, and they're able to leave that piece. They've turned over that stone and they've dealt with it. So you definitely don't want salt to ruin your retirement. There's no reason for it.
I was waiting for that pun, Ben.
I feel like if there's anything, a retirement needs to be sugary, not salty. I would say you should enter a stage in your life where it's not, where that doesn't come back up as an issue. So that's certainly an important point to keep in mind. And acquisitions are a big part of that.
I know we're going through a lot of information. I just had one more question before we wrap up. There's a difference between compliance and consulting. I know that, but for the audience, Kelsey, can you give some guidance and additional information about that difference?
Yeah, absolutely. So like I kind of earlier mentioned, from the consulting side, we can really help with the historic lookbacks, right? Or if there were to be an audit that pops up, we can also provide audit assistance there in consulting. Even if you have an audit in play, right, and it looks like there's going to be no negative assessment, you still want an advisor to come in and review that process, perhaps run the same type of sample that the auditor did, because maybe there's money that you've been over collecting on. If they just seem to get in and out the door with no negative assessment, then there might be money on the table that you've been over collecting, right? And so we can help make that determination either way on the consulting side. But from a compliance perspective, investors really like to see best-in-class processes in place. We can either help do the returns for you, or if you have compatible systems, we can work with one of our technology partners to get an automated process in place. And either way, you're better off than doing it manually, I say. It's crazy once you cross beyond 3 to 5 states to try to continue to do it manually without a full team behind it, which is incredibly costly when you think of headcount required for that. So
true. So true. And everything is changing so quickly. It's not just on the state level, though, right? Because we have county. I know here in Illinois, there's a store right on Lake Cook Road. Doesn't mean much to most people, but on Lake Cook Road, it has a store in Lake County. It says buy here because you don't have to pay Cook County taxes. And I mean, that all needs to be taken into consideration as well, doesn't it?
Okay. So that's probably why Ben loves the States, right? He mentioned it. It's like 50 many different countries, but
and there's thousands and thousands
you go across the yeah, like Colorado, Louisiana, Alabama, they all have incredibly complex local jurisdictions. Washington, California, Texas, Illinois. New York, Illinois, taxes SAS in the city of Chicago, but not the rest of the state most of the time. So yeah, I mean, it's while there are some simplification efforts going on in states like Colorado and Louisiana, it still continues to be complex. An advisor, you might not know that those changes are even on the horizon. So
well, and that's the other thing you bring up, Kelsey. That's a good point. It could change, and you're a business, and you think you're compliant, but you had no clue that it changed. Mm-hmm. And that's from what my experience in working with CPAs and clients, and having you, the two of you, join in on some of these conversations, bringing people up to speed and letting them know, hey, this is what it was 6 months ago, a year ago, 2 years ago, but the rules have changed and the requirements have changed, and now you need to do this.
And Michael, I think you the question you asked about consulting versus compliance, I think this is where it really comes to a head. Compliance is getting the taxes done. So compliance is what CPAs do with your federal tax return, oftentimes with your state tax returns. Sometimes they'll do it with sales tax returns, sometimes they won't, but the compliance is getting the tax returns in. That is a matter of compliance. Consulting is about getting it right. It's about the strategy. It's about making sure that if you've done anything wrong, making sure that that's looked after. If you've got ambiguities, to figure out those ambiguities. So the great part of it is from a state and local.
And one thing we've noticed, even with some,
No, go ahead, Kelsey.
Oh, I was going to say, like, one thing that we've noticed with some of our technology partners even is when these changes come up, right? Maybe they have their tax code set in a certain manner, but they might be missing one that has been added to accommodate for a state change, right? So I think the combination of, automation plus a consulting service provider like ourselves is really the best route to make sure you're getting it right. But
I completely agree with that. I think you definitely don't want to be in a situation where you're solely guided by technology, because realistically, the ambiguities and the subjectivity of a lot of what it is that state and local tax stands for. And also the reality is it's not limited to sales tax. There are other complexities in state and local taxes. I remember a little while ago, someone asked me, so I hear state tax, where's the local taxes? Why is it called SALT? And Michael, as you mentioned before, and as Kelsey reiterated, local taxes come down to the county. Think about, I live in New York City. I pay a local tax. I pay a state tax. There are exemptions from my perspective as paying it. There are exemptions from collecting it. So having full visibility over your multi-state footprint, both from a state, a local, and even a county level standpoint, is really important.
Yeah. We only got to a fraction of our questions, and I apologize. There's so much to unpack here. More than likely, Kelsey and Ben, if you're open to it, having a follow-up conversation about this and continuing to help people understand the complexity, unpack it, recognize the need to do it right the first time, like we talked about. If it wasn't done right the first time, it's not the end of the world. We can help clients, CPAs, understand the right approach and the right process. Any parting points that you want to make before we wrap up? Ben or Kelsey?
Gosh, I think just like one of the biggest misconceptions.
I stung you with that question.
Yeah, I'm like, there's so many more things that we didn't get to today. But, even if you historically didn't have a footprint, historically thought you were off the hook for taxes. I talked to so many different manufacturers that think just because they're exempt, they don't have to get registered with the state and file $0 returns. But over half of the US states now look at gross sales in those economic nexus thresholds. So if you haven't done a review yet, please contact us. It might not mean that you have any historic liability, but you should probably get registered on a look forward basis, right? So that's just like one main takeaway that I would like everyone to leave with. We've also seen a large uptick in audits around like service-based businesses or SaaS-based businesses that maybe have customized software versus canned software. That's, I've been working on a lot of audit assistance projects in that area too. So please let us know if you have, any issues there. But
Absolutely.
And parting words from me, I would say, first and foremost, this webinar is titled, or this discussion is titled Being Worth Your Salt in 2024. If you want to be worth your salt in 2024, if you want to make sure that your state and local tax affairs are buttoned up, looked after, I would say look inside your business and ask yourself 3 questions. Are you part of the type of business that are you the kind of business that has operations in 3 or more states? So are you touching 3 or more states? Employing in, storing in, traveling to, selling into, all the different ways you can touch it. If you are, how long have you been around for? Have you been around for more than 3 years? So that's 3 states, 3 years. And the final piece is, how much revenue are you generating? How likely are you to feel the burn of going through a process that buttons you up for being around? So I would say if you have $3 million in revenue or more, if you meet those 3 criteria, being worth your salt in 2024 means reaching out to a salt expert, and Source Advisors is obviously a primary candidate for you to speak to. Mm-hmm. Being worth your salt in 2024 is about making sure that if you meet those criteria, you're out there dealing with it, because it's a great time to get on top of it. It's the beginning of the year. It's tax time. There are ways in which you can start that conversation, have that conversation. And if you do, you will definitely be worth your salt in 2024.
Beautiful. Beautiful. Thank you both. I know I told you originally, it's usually about 18 to 22 minutes. This, again, we haven't even gotten to the full conversation and dug in deeper on it. We will have a follow-up. Parting words, thank you everyone for watching, listening. This will be posted so you can refer back to it anytime. Reach out to Ben, reach out to Kelsey if you do have questions related to your business. CPAs, reach out to Ben and Kelsey if you have questions related to the practice for your clients, all about salt. Also, anything related to R&D, cost seg, energy, or LIFO. That's what we're here to do, is help educate first our CPAs and our clients and guide them and give them the right direction right from the start. Thank you again, everyone, for joining. Be well, enjoy the rest of your day, and have a great weekend. Take care.
Thank you for facilitating, Michael.
Be well.
Yep. Happy Friday. Thanks.